Hello, this is Bob Steele. In this lecture, we'll take a look at a problem that will be similar to a homework and or assignment. The numbers will change. The format will remain much the same. We're going to be working this problem with this Excel sheet. I do suggest using an Excel sheet and then putting it into Connect because Excel will help you with the calculations. It'll help you see relationships between numbers. And if you have to work the problem again, it'd be good to have in Excel as well as just Excel being good to know in general. So we're going to be working with time value of money here. So we have a corporation is considering a new project requiring a $90,000 investment in test equipment with no salvage value. The project would produce $66,000 of pre-tax income before depreciation at the end of the next 6 years. The company's income tax rate is 40%. In compiling its tax return and computing its income tax payments, the company can choose between the two alternative depreciation schedules. Alright, so what we have here is the straight line method and the maker's method, a kind of double declining method for depreciation on taxes. So you can see the differences in the depreciation. What this is indicating is the allocation of the cost of the machine, of course, the $90,000 over this 5-year period. You can see that the maker's is more front-loaded, meaning we're depreciating or expensing more of it in the first years, and the straight line is more even, where we're going to depreciate more evenly throughout the years. So required complete the following table, assuming use of straight line depreciation. Net cash flow equals the amount of income before depreciation minus income taxes. So what I've done is I've just put those same numbers into our table here. So here's our straight line and here is our maker's table here. So if we're going to calculate then what would be the cash flow for these two types of methods, if we were going to take these two types of methods on, then first we can say that the income before depreciation is given to us in the problem, and that is the $66,000. So we're going to say the income for each of the 5 years is $66,000. It's just going to be the same all the way down. 6 years, I should say. It's going to be the same all the way down. And then I'm going to first evaluate the straight line method. So if we evaluate the straight line method, we would then say that we have these numbers. I'm just going to plug these numbers in, so we can just copy those down. So the straight line depreciation method would be using these numbers. And then notice what the depreciation is. It's a non-cash flow item, because really we're putting the $90,000 down at the beginning of the time period, even though we're allocating the expense over the 6-year period. So it will affect the net income and therefore our taxes. But our cash flow is different. Our cash flow is $90,000. It's going out up front, and then and that's different than the way the expense is being depreciated. So to calculate the income tax, then for each of these years, we'd have an expense or a deduction of the depreciation in this format. Therefore, each of these years, if we had $66,000 each year minus this expense, this deduction, this depreciation expense for each year, we can copy that down. Then that would be our taxable income throughout that time frame. So then our income taxes then, remember that our tax rate was 40%. So if we take our taxable income times 0.4, that would give us the income tax. So if we copy that down, that's how much income tax we're going to pay each year. So that's the $122,400. And then now we're trying to figure out the net cash flow. So we're not trying to figure out net income. Net income would be this minus this. But what we're thinking about is how long will it take us to retrieve or get our money back. So we're not talking about net income in this case. We're talking about the cash flow. So instead of us taking net income or taxable income minus income to give us net income at this point after taxes, we're going to take the cash flow, the 66 here, minus the tax that's going to go out, the money that's actually going to go out due to taxes here. And that will give us our 43.2. So we can copy that down. That's the cash flow that will result from the use of the straight line method. And then what we're going to do is we want to present value this method now. So when we use the present value, the tables are at the end of the book. I've actually copied them down here as well. So what we're going to do is we're going to look at our table and we're going to try to bring these down to today's dollars, basically. So if we take a look at all these, we know that the second year the value of the dollar is less than if we had the money in the first year, because of the time value of money and because of other things we could do with the money, meaning we could invest it somewhere else. So note that the problem is telling us that, that we're going to use the 10% as the discount rate. So that's going to be the discount rate that we will be using in order to present value this number. And once again, that accounts for the fact that there's a time value of money, meaning there's inflation, the money goes down in value, and the alternative investments that we could put the money in. So if we scroll down here to our present value of 1 table and we go to the 10% row here, then we can then figure this out. We're going to say, well, obviously if we had the money today, that would be in today's dollars. If it's a year from today at 10% discount, we have to multiply it times 0.9091 because that would be the discount rate to get it down into today's dollars. If it's 2 years out, in this case, we have to multiply whatever the dollar amount is times 0.8264. If it's 3 years out, it's gonna be a lesser amount, right? 0.75, and so on and so forth. We're going to take these numbers down to year 6, and that's what we'll plug into our table up here to present value it. So I'm going to say that after 1 year, I got to take that times 0.9091. And of course, if you want to know how to derive these formulas and where they're coming from, they're here, and you can look at the appendix at the end of the book in order to see how these tables are generated. But once they are generated, the easiest thing to do is take it from the table here, and so that's what we'll work on. And so we're taking, if it's 1 year out, then the cash flow is 43.2, but we're going to get it a year later. So at a discount rate of 10, then it's only worth today's dollars of 39,273 at the discount rate of 10. 2 years out, we're going to say 0.8264 from that table. Also note that the Excel is formatted in so that I can see 4 decimals here, so that's using these items here. So I'm going to say this is this times that. So now we're going to say that 46.8 is really only 38,676 in today's dollars. Then we're going to say the next discount rate 3 years out is 0.7513 according to the table. So that same 46.8, but it's 3 years out. Therefore, it's a reduced present value of the 35,161. And then we have the 0.6830 next period out. Once again, same 46.8, but now it's only worth 31.9 because it's 4 years out. And then if we go 5 years out, 0.6209, we're going to say, oh, now it started to do it for us, but we're going to say this number times this, and now it's only worth that. And then the last year, we're going to take 0.5645, and that calculated out for us. So if we sum this up, then we're going to say in today's dollars, in present value dollars, it accounts for the 198,518. And then we can compare that to the cash that we put in. So remember, we put in an initial 90,000 up front. So the cash went out in year 1. So there's no present value needed there. How much cash went out? 90, well, not there. 90,000 down here. 90,000 is how much went out. Therefore, this minus or plus this. And usually, I usually don't put negative numbers in the Excel. I usually would put a minus sign here, but I believe Connect is putting a negative there. So I'm trying to match Connect. So obviously, when I add these up, I'm saying this plus a negative. It's the same as saying this minus this, of course, is the 108 here. So if we did the same thing with comparing that to the makers, so let's just put in the depreciation for makers. We're going to say it's the same 66 here. That's how much income that we are going to be generating. And then the straight line should now be not straight line. It should be makers. And this is the tax depreciation. It's very similar to double declining balance. It's an accelerated method. So we have this, and we can copy that down. So we can compare the depreciation methods here, of course, being more front-loaded, meaning we're expensing more in the early years than later years, which should be a tax benefit for the most part. So if we then subtract these out, then this would be our taxable income, and if we copied that down, we can see our taxable income is lower in the first years, and then it's higher in the later years. And if we have a time value of money, and we realize that the fact that there's a discount of 10%, that should be a benefit to us. We would rather write stuff off early rather than later, even though we're still writing off just the 90,000 over the full time period. So then the income taxes then will be this times 0.4, because we're going to pay Uncle Sam a 40% rate on that. So we can copy that down, and of course our tax is smaller. The burden is smaller in the first years, and it's larger in the later years. And then, and if we add them up, it's 122.4. The tax burden here is 122.4. Same tax burden, but we're paying it later, which is better because we get to hold on to our money longer. And so then we can subtract that out. We can say this is how much cash we're going to get. This is how much is going to go to Uncle Sam. And we can copy that down like so. And then if we did our same present value, the same tables, present value tables are the same up here, and we were to multiply this out, then we're going to say, well, we got cash flow of 46 now instead of the 43. If we present value it, then that first year we have comparatively more. And the second year we had the 51, and we're going to present value that at 82. Once again, comparatively more. And then we have the 46 times this. Once again, we're now it's actually going down, so now we're less in year 3, and then we're going to continue this process down as we go. And so that's the present value of the cash flows. If we sum those up, then we come up to a current present value of cash flows, which is larger. So of course this would be beneficial because we'd rather take advantage of the time value of money and depreciate everything up front if possible. And then we have our 90,000 investment, which is the same, and we can sum those up, and there we have that.